Common banking errors that cost you money and how to avoid them. Banking mistakes can quietly drain your finances if you're not careful. From overdraft fees to forgotten automatic payments, small errors can accumulate into significant losses over time. Many of these missteps are easily avoidable with a bit of attention and planning. Whether it's not reading the fine print, ignoring interest rates, or relying too heavily on credit, understanding these common pitfalls can help you keep more of your hard-earned money and manage your finances more effectively. 1. Overdrafting accounts. Overdrafting occurs when you spend more money than you have in your account, leading to steep overdraft fees. Many banks charge anywhere from $25 to $35 per overdraft, which can quickly add up if multiple transactions occur. To avoid this, keep track of your balance through banking apps or alerts. Also, consider linking a savings account to cover overdrafts automatically or opting out of overdraft protection altogether, which prevents transactions from going through if your balance is too low. 2. Paying unnecessary fees. Banking fees, like ATM surcharges, monthly maintenance fees, or paper statement charges, can be easily avoided. Most banks offer free checking accounts if you meet certain requirements, like maintaining a minimum balance or setting up direct deposits. Additionally, withdrawing cash from your bank's ATMs instead of third-party machines will save on ATM fees. Being proactive in understanding the fees associated with your account and how to avoid them is essential to keeping your money safe from these hidden costs. 3. Ignoring minimum balance requirements. Many checking or savings accounts have minimum balance requirements to avoid fees. If your balance falls below the required amount, your bank could charge a maintenance fee, which may range between $10 to $25 monthly. These fees can quickly deplete your savings if left unchecked. Keep track of these minimums or switch to a bank that offers no minimum balance accounts. Setting up low balance alerts through your banking app can also help you avoid dipping below the required threshold. 4. Forgetting about auto payments. Setting up automatic bill payments is convenient but can lead to issues if you don't monitor your account closely. Forgotten auto payments can result in overdraft fees or missed payments when your balance is low. It's essential to regularly review your automatic payments to ensure you're not paying for unused subscriptions or services. Additionally, set reminders for payment dates and always ensure you have enough funds in your account to cover these charges, preventing fees or service disruptions. 5. Not reviewing bank statements. Failing to regularly review your bank statements can lead to undetected errors or fraud. Mistakes in transactions, unauthorized charges, or even forgotten fees can go unnoticed if you don't check your statements regularly. Make it a habit to review your bank account activity either through online banking or physical statements. Catching discrepancies early can save you from long-term financial damage, and many banks offer dispute services to correct any errors you may find. 6. Mismanaging credit cards. Using credit cards without a repayment plan can lead to high-interest debt that's difficult to manage. Missing payments or only making minimum payments can increase your debt due to interest accumulation and late fees. Always aim to pay your balance in full each month, or at least more than the minimum to reduce interest charges. Keeping track of your spending and setting up automatic payments can help you avoid late fees and maintain a healthy credit score. 7. Neglecting to shop around for better interest rates. Many people settle for low-interest savings accounts without exploring better options. By not shopping around for higher interest rates, you miss out on earning more from your savings. Consider looking into high-yield savings accounts, online banks, or credit unions, which often offer better rates. Regularly compare rates and consider moving your money to accounts with higher returns. Even a small difference in interest rates can significantly impact your long-term savings growth. 8. Relying on payday loans. Payday loans may seem like a quick fix during financial difficulties, but they come with extremely high interest rates and fees. The average payday loan interest rate can be over 400%, trapping borrowers in a cycle of debt. Instead of relying on these loans, explore alternatives like borrowing from friends or family, credit unions, or emergency funds. Building an emergency savings account can also help prevent the need for high-interest loans when unexpected expenses arise. 9. Ignoring credit reports. Failing to regularly check your credit report can lead to overlooked errors or signs of identity theft that can harm your credit score. A lower credit score results in higher interest rates for loans and mortgages, costing you more in the long run. Checking your credit report annually allows you to spot and dispute any inaccuracies early. Services like annualcreditreport.com offer free credit reports from major bureaus, making it easy to stay on top of your credit health. 10. Leaving accounts dormant. Keeping a bank account open but unused can result in inactivity fees or even account closure by the bank. Many banks charge monthly fees for dormant accounts, which can eat away at your balance. To avoid this, either actively use the account by making small transactions or close the account if it's no longer needed. Make sure to review the bank's terms and conditions for inactivity to prevent these avoidable charges. 11. Not taking advantage of employer matching contributions. Many employers offer matching contributions to retirement accounts like 401ks, but some employees don't take full advantage of this benefit. By not contributing enough to qualify for the full match, you're essentially leaving free money on the table. Ensure you're contributing at least the minimum amount required to receive the full match from your employer. This not only boosts your retirement savings, but also ensures you're maximizing the benefits of your compensation package. 12. Overlooking online bank offers. Traditional banks may offer lower interest rates and higher fees compared to online banks. By overlooking online banking options, you miss out on potentially higher returns for savings accounts and lower fees for checking accounts. Online banks, without the overhead costs of physical branches, often provide competitive rates and fewer fees. It's worth researching online banking offers, especially for savings accounts, to ensure you're getting the best return on your deposits and minimizing costs. 13. Not setting financial goals. Failing to set clear financial goals can lead to disorganized spending and missed opportunities for savings. Without a plan, it's easy to overspend, neglect retirement contributions, or miss out on important financial milestones. Setting specific goals, whether it's saving for a home, building an emergency fund, or planning for retirement, helps direct your spending and saving habits. Financial planning tools, budgeting apps, or consulting with a financial advisor can help you create and stick to a plan that supports your long-term financial health. 14. Falling for fraud and scams. Banking scams, such as phishing emails, phone fraud, or fake websites, can lead to significant financial losses. Fraudsters often target unsuspecting individuals, tricking them into revealing personal banking information. To protect yourself, never share sensitive information like your account number or passwords with anyone. Use two-factor authentication when available, and monitor your account for any suspicious activity. Educate yourself about common scams and always verify the legitimacy of any communication claiming to be from your bank. 15. Not automating savings. Many people fail to save consistently because they don't automate their savings. Setting up automatic transfers from your checking account to your savings account can ensure you're putting money aside regularly without having to think about it. This strategy helps you build an emergency fund or save for specific goals without relying on willpower alone. Automating savings is a simple but effective way to ensure you're consistently working toward your financial goals without the temptation to spend the money. Each of these mistakes can have a long-term impact on your finances, but being aware of them and taking proactive steps can significantly improve your financial well-being. Thanks for watching the video. Please subscribe.